Here's the truth about property. Timing can make or break your entire portfolio. You can buy the right suburb, the right house, the right strategy, but if you get the timing wrong, well, you can be sitting on dead money for years. Take Sydney back in 2012. If you had bought back then you'd have tripled your money inside a decade. Same with Perth in 2019. Investors who moved early are now riding one of the strongest markets anywhere in the country. But here's the question that matters right now. When's the next window? When is the next moment where the market hands everyday buyers an unfair advantage? Well, I'm gonna tell you straight. I believe that window is 2026. And I don't say that lightly, because when you line up all of the data, interest rates, approvals, completions, migration, vacancy rates, even government policy, everything points to 2026 being one of the best buying opportunities we've seen in recent history. But here's the crazy part. Not every buyer in 2026 is going to win. Some people will actually get burned. Later in this video, I'm going to show you exactly who those people are and how you can avoid becoming one of them. So with that said, let me show you why the next 18 months of positioning matter more than anything. Because if you miss this window, you might be waiting close to a decade for the next one. Guys, my name's Josh. I'm from DataEdge Property and I help everyday Australians grow their wealth in the Australian property market using data. Data that's accessible to absolutely everyone. And if you get value out of today's video, make sure you smash that like button and hit subscribe so that you can see more data-driven content just like this. And with that said, let's look at the signals that are pushing us towards 2026. When you zoom out, you can see all of the signals beginning to line up. So firstly, let's talk about interest rates. So we're currently sitting at a cash rate of 3.6%, but if we look at what the market is currently signaling, we're expecting that there will be at least one more rate cut to come. So that cash rate, based on what the market's currently forecasting, will get to 3.35%. And the major banks and all of the major forecasters at the moment are kind of split whether there's going to be one or whether there's going to be two. But the fact is that rates are likely on their way down in the short to medium term. And what that means is that as a whole, borrowing power of your average Australian is likely to increase. And we know that when borrowing power improves, that places upwards pressure on house prices. Secondly, we have a massive supply crunch, and that's despite the government's target of building 1 million homes across the next decade. If we look at the most recent ABS data from July 2025, dwelling approvals fell 8.2% to just 15,769. Now that's the lowest level that we've seen in years. And completions are dragging because builders are still collapsing, but also we just don't have enough builders in the country. I mean, you have places like in Western Australia where they're literally trying to fly people in from New Zealand to get houses off the ground. So there is a massive shortage in the supply pipeline, and it doesn't appear like that's going to be improving anytime soon. And even if approvals do tick up, well, supply will still be lagging well into 2026. And that brings me into this third signal, which is population growth. Now, it's no secret that Australia has seen a massive surge in population growth since the onset of COVID. Net overseas migration for the 2023-2024 year was at 446,000 people. But at the same time, we only built 163,000 homes. So in that same period, demand has clearly run far ahead of supply. And even if migration slows slightly, that gap isn't going to close. And from everything that I've been seeing, the rate of population growth is only slowing ever so modestly. And as we've just discussed, supply is not improving. On top of that, we have a rental crisis. Vacancy rates are sitting at just 1.2% nationally. And for those that aren't familiar with vacancy rates, typically a balanced market, that's effectively when there's enough stock or rental stock going around for the number of renters that are seeking it, vacancy rates sit at 3% in a balanced market. So we're currently chronically undersupplied in terms of rental stock. And in cities like Perth, Adelaide and Hobart, that figure is well under 1%. So tenants are under extreme pressure and investors are clearly seeing the opportunity. Lastly, and this could be one of the biggest signals of them all, is the introduction of government schemes like the 5% first home buyer deposit scheme, which effectively it's going to just supercharge demand. And by the way, if you wanted a full breakdown of how that 5% government guaranteed deposit scheme works, who qualifies and what it means for prices right now, I did an entire video on it. Watch that after this one. It'll be in the link down the description box down below, and it'll also be up here because it ties directly into why 2026 looks so strong for buyers. And the unfortunate reality is this mix doesn't just nudge prices higher. It creates one of those rare windows where everyday buyers can actually jump ahead of the curve. To see why, we need to talk about timing. So why does timing matter so much when it comes to property? Well, Australian property, it moves in cycles: credit, supply, and sentiment. Buying when credit loosens and supply is tight sets you up for growth. And that's exactly what makes 2026 so interesting. You have rates easing, you have supply majorly constrained, you have demand elevated, and you compare that to the prior year where you had almost the opposite conditions. You had higher interest rates that were crushing borrowing power and momentum just wasn't there. It was there in certain cities like Perth, Brisbane to an extent, but we didn't see those conditions nationally. And I think that's going to be the difference maker in 2026. You're going to see this type of sentiment permeate the national market, and we're likely going to see a national housing boom across the board, something we haven't seen since the pandemic. And when timing, supply, and demand collide like this, the results can truly be explosive. So with that said, what might 2026 really deliver in terms of prices? And what's the best case, base case, and downside scenario? Let's break that down. So here's what I see playing out. In my base case, I think that national prices across Australia are going to rise between 6 and 8% throughout 2026 as demand rebounds. Now, what are the assumptions behind this? Well, this assumes that the RBA follows through with its gradual rate cuts into 2025 and then well into 2026. I'd want to see at least 1 to 2 more rate cuts beyond where we're at right now. At the same time, migration would need to stay strong. Now, I'm not saying it would need to increase under this scenario, but at least remain at the level that it currently is growing at. At the same time, supply would need to remain weak because of low approval levels and ongoing builder failures, which we're seeing no shortage of at the moment. So in other words, I'd want to see credit get a little bit easier, demand stays elevated, and supply simply unable to keep up. So that's kind of my most likely scenario. So what about my upside case? Well, if credit loosens quicker than expected, we could very well see growth that exceeds 10% nationally. Now, what would need to happen for that to occur? Well, we would need credit to loosen faster than what's currently expected by the market. And in practical terms, that would mean at least 3 to 5 more interest rate cuts from the RBA. Now, although that's not what the market's currently forecasting, that's what would need to happen for this scenario to play out. But it's not just interest rates, it's also broader credit policy. I would want to see banks compete more aggressively with serviceability policy, potentially loosen some of the more stringent policies that they have on the books. But it's not just the banks. It's also APRA. So currently we have a buffer rate that's applied by APRA where borrowers are required to be assessed with a rate that's 3% higher than their actual rate. Now, it didn't always used to be that high. So if potentially APRA loosen that buffer rate and reduce it to say 2.5% or 2%, again, that could give us the effect of potentially an extra 2 or 3 rate cuts without even getting a rate cut. Now you combine that with listings remaining scarce and you've got the perfect conditions for national double-digit growth in Australia's housing market. What about my downside case? Well, even if unemployment rises or let's say construction activity heats up and we do get some increased supply in the system or potentially there's no more rate cuts, well, I would still be surprised if we got anything less than 2 to 4% growth nationally, because At the end of the day, supply is still heavily constrained. Migration is still strong, and it doesn't look like we're going to see any change in policy from that regard. And lastly, again, the government incentives that are being brought in are simply going to supercharge demand in a way that we currently are not seeing. At the end of the day, supply is too far behind to create a real correction at this point in the market. That's why even in my downside scenario, it's still positive growth, it's just muted. And this is exactly where due diligence matters more than ever. It's not enough simply to ride the wave. You've got to buy the right asset. So make sure you grab my completely free asset due diligence checklist in the description box down below. It's the exact framework that I use when I assess property transactions, and I use it to filter out those weak assets. It's completely free, grab it in the description box down below. So we've spoken about the forecasts for 2026, but rising prices, they don't guarantee success. So let me show you the exact strategies and markets that I believe will thrive in 2026. Now, if this video is helping you think differently about the Australian property market, make sure you leave a like. I'd really appreciate it, and it helps more people see content just like this. Also, make sure that you subscribe so that you can see more data-driven content on the Australian property market moving forward. So with that said, how should you position yourself in 2026? Well, the answer is strategy. So firstly, you want to be focusing on quality suburbs, not just ones that have strong data metrics and a massive imbalance between supply and demand, but also ones that have sound qualitative characteristics too. So for example, a strong jobs market, amazing schools for the local owner occupiers in the area, infrastructure spend in that area, and also lifestyle and amenity factors that are going to attract both renters and owner occupiers to that area. Secondly, it'll be the mid-tier family markets, the ones where there's going to be strong upgraded demand. Now, if you've been following the Cotality data in recent years, you'll know that the majority of the price growth in recent years has been driven by the affordable pockets. Now, that price growth in the affordable pockets is eventually going to permeate into the mid-market and then the upper markets. So you want to be positioning yourself to take advantage of that growth. Thirdly, and I bang on about this all the time, but you want to be buying assets with value add potential. The market's not always going to be going gangbusters like it likely will in 2026. It will moderate at some point. It always does. You want to be able to own an asset where you can add value yourself, whether that be through renovations, whether that be through subdivisions, or maybe even developments. It doesn't matter, but you want to have that ability to add value to an asset where you're not having to depend on the market for growth. Lastly, you want to be able to diversify your exposures across states. Now, people know about this very well in the stock market. They always say you want to diversify, but for whatever reason in property, people love buying in their own backyard. So if you already own a bunch of properties in a particular state, then you should consider, or at least have a look at, the other markets around the country. There might be better opportunities elsewhere that might present with a stronger yield and stronger capital growth in the short to medium term. For example, at the moment, there are pockets of Perth, Brisbane, and Melbourne that look particularly strong, whereas there's other pockets of the country that aren't looking as strong. Take Perth, for example. It's one of the hottest markets right now anywhere in the country. And I actually did a completely full data-driven breakdown of the top 5 suburbs that I think will benefit in Perth in 2026. Make sure you watch that one after this one if you want to have an idea of which suburbs are likely poised for growth in Perth heading into next year. But before we wrap up, let me give you my single biggest takeaway heading into 2026 that most buyers will miss. And it could be the difference between building wealth and being stuck for another decade ahead. 2026 is shaping up as one of the strongest buying windows that we've seen in years. You've got lower rates, tight supply, strong migration, and ongoing incentives from the government, some which are just about to kick off. But not everyone who buys in 2026 is going to win. The people who chase whatever fits their budget may actually get stung, whereas the people who focus on fundamentals, the right suburbs, and smart deal analysis, well, they'll be the ones who look back at 2026 as the year that their portfolios really took off. Guys, thanks so much for watching. I really appreciate your time. If you found this video valuable, make sure you hit subscribe, hit the like button. You're gonna see more video just like this. I'm gonna be releasing plenty more data-driven analysis on the Australian property market. And with that said, I'll see you in the next one.